Good afternoon, everyone, and thank you for joining us for today's episode of Market Happy Hour. You're going to see a lot of fancy lawyer language on the screen in front of you. All we ask is please no audio or video recordings of today's presentation. Your host for today's Market Happy Hour is going to be myself, Daniel London, Vice President of Private Wealth Management here at Capital Wealth Advisors. Along with me, I have our Chief Investment Officer, Lewis Johnson, our Director of Research, Zev Abraham, and our guest today, Rich Howard, former portfolio manager of T. Rowe Price's Capital Appreciation Fund. Now, before we begin, you're welcome to submit questions throughout the course of the presentation. We may have the chance to field one or two of them through the presentation, but we'll most likely save those for the end of the presentation. We do also ask that you take a couple minutes to complete the exit survey. The feedback is incredibly helpful as we work continuously to improve this and make it valuable for all of our participants. Now for today's agenda, we're going to hear a little bit about Rich's background, where he came from, how he got in the world of finance, and his career through that. Then we'll have Rich share kind of the lessons he's learned through 50 years of investing at a very, very high level. And we'll close up with a question and answer segment. Without further ado, I'll turn it over to Lewis Johnson to introduce Rich.
Hey, thanks, Daniel, and welcome everybody again. We really appreciate the time that you take to learn about how we're kind of viewing the markets, how our processes are working, and how we're trying to do a better job navigating volatile markets. And we're really blessed today with a wonderful guest. I've known Rich Howard for more than 20 years now. We worked together at T. Rowe Price for some time. And there are many things that I could, say about Rich, and he's just an amazingly talented value investor, and he's been a good friend over the many years. He's very kind to take my phone calls when I ring him up, and so Rich and I talked quite a bit, and I was finally able to talk him into kind of having a session with us on Market Happy Hour, talk about the things that he wanted to talk about, and so Rich can kind of do a better job summarizing, his background, and then talk about things he thinks are important that we can learn from as investors. And I would just kind of end by saying, of all the things that I think I enjoyed or learned from at T. Rowe, they definitely had a practice that was very laudable, and that was where they would have the senior portfolio managers kind of talk, just kind of quietly and unscripted about lessons learned and how they were thinking about things. And I always found that was probably the highest point of learning that I had during my experience there. So that's the kind of process I was hoping to repeat today. So Rich, I'll turn it over to you. The floor is yours.
Hey, thank you, Lewis. So as you heard, the contents have been sort of left up to me, and so I'd like to talk about investing. And I'd like to do it through perhaps an unusual lens. First, I'm going to tell I believe the word is apocryphal story about the Fed, which I think you'll find enlightening. Then I'm going to introduce you to two books, both of which were published more than 125 years ago, which I found tremendously helpful in my understanding of investing, even though these books are not really about investing, but they capture some of the more significant and subtle aspects of it. Then I'm going to answer questions. I'm sure there'll be a few. And then finally, if we have time, I'll talk about my book, which you see there, Aramco Brat: How Arabia, Oil, Gold, and Tragedy Shaped My Life. It's the story of my life up to age 18, which was rather unusual, to say the least. Okay, let me start with a story. It's about 1965, and there's a high school student working at a suburban Chrysler dealership in Atlanta. He's in the service department. He's, changing carburetor filters and fixing tires, etc. And about this time, the management comes into the service department and says, look at your parts system is completely screwed up. What's going on here? computers are, you've got to figure out how to do this. Well, nobody wants to handle these computers, so our auto mechanic, high school auto mechanic, says he'll do it, and so he takes on the task. And what do you know? He does a fantastic job. He does the parts, and then he starts doing the new car invoices. And pretty soon he's doing the financials of the whole operation, the accounting system. And he does such a great job over the next 2 years that his boss is lauding him at a meeting with the Atlanta Federal Reserve Bank president. And the Federal Reserve Bank president says, you know, we got this terrible check problem. We can't, there's so many checks, we need to computerize. So he's asked, well, would he go to the Fed and do this? So he does. Starts working at the Fed. He's worked there for about 2 years. They transfer him down to Miami, and somebody has the bright idea, maybe he should go to college. So he goes to college, and 8 years after he graduates from high school, he gets his Bachelor of Business Administration. He's been in the Fed this whole time. And long story short, 44 years later, he retires from the Fed. But there's more to the story. At one point, he goes out to San Francisco. He's chief operating officer at the San Francisco Fed. Then he gets a chance to come back to Atlanta, where he always wants to be. He's made vice president of the Atlanta Fed. And it's 2006. And the president of the Atlanta Fed has got a terminal illness. And so our auto mechanic is sent to a meeting of all the high Fed monkey mucks. And he goes up to, I think it's New York. Goes up to New York. And he sits there quietly for the first meeting. And then the second meeting, it's now the fall of 2006. He says, you know, I hear a lot about some subprime problems that we're having down in Atlanta. Does anyone think that, you know, maybe we should consider thinking about this? Well, all the PhDs in the Fed, I guess rather than me say it, you can figure out how they respond to our auto mechanic, and the rest is history. I mean, the Fed knows absolutely nothing that hits them in the face in 07 and 08. All right, that's my story about the Fed. So if you think the Fed is going to take care of you, you're wrong. Let's go to my first book. My first book is Fiat Money. Oh, awesome. Yeah. Fiat Money Inflation in France. It's about 70 pages long. It's a very easy read. It was written in 1896 by Andrew Dickson White. And it discusses the turmoil around the introduction of paper money in France between 1790 and 1795. Now, 1790 France was in a bad way. A lot of the nobles had left the country. There was, the Reign of Terror. All us good high school history teachers will tell you about the Reign of Terror and Robespierre and all that, razzmatazz, but they don't tell you what the real problem was. And the real problem was the introduction of paper money. And it all started so innocently. We're having trouble. We can't seem to get the economy going. And why don't we just introduce this paper money, and it'll grease the wheels of commerce and everything will be fine. And so they did. And it worked. But after a while, it didn't work so well. So they did it again. And it worked. And after a while, it didn't work so well. So they did it again. And it worked. It sounds kind of like the Fed goosing our economy by debasing the currency, doesn't it? So they did it, and they did it, and they did it, and pretty soon they had to introduce price controls because prices were just soaring. These prices are ridiculous. We can't have price control. People can't have to pay so much for bread or milk, or sounds like windfall profits tax to me. And so they did, and things just kept getting worse. And they noticed that, or Mr. White noticed actually, that commerce gradually died out. Speculators who were knowledgeable at buying and selling these things suddenly became very wealthy. Sounds like hedge funds managers, doesn't it? Betting is in, hard work and thrift is out. By the time this was over, they basically destroyed the country. Paper money ended up in the hands of the lower classes. All the people that were supposedly being helped by these politicians were in fact the big losers. The a huge speculating class had grown, and these were the people that had all the money. I like a couple things in the book, some really resonate with me. Here's a sentence that I just have to repeat verbatim. It began to be especially noted that men who had never shown any ability to make or increase their own fortunes abounded in brilliant plans for creating and increasing national wealth. Sounds a bit like Bernie Sanders, doesn't it? Anyway, Bernie's never said anything bad about me, but nevertheless. So I urge you to read this book. It is, as I said, very short, very simple, and very worthwhile. Next book.
Well, and before we get on to that, I just wanted to recommend everybody definitely follow Rich's advice on that. Probably half the books on my shelf are kind of on this topic of inflation, and that's one of the seminal ones. So, congrats on that. It's a wonderful, wonderful read.
On that topic, Lewis had me read a book about German inflation written by some Italian guy once, and I got to say, fiat money inflation in France is a lot easier to read than the one you made me read.
Right. The one I gave you is better, but we can have this argument later. Don't worry about it.
Okay, I'm sure you're right. Okay, so let's talk about the record. This is a considerably longer book, written, I think it was published in 1891 by Robert Louis Stevenson and Lloyd Osborne. Everybody knows Robert Louis Stevenson from Treasure Island and Kidnapped and some of his great books. And this book has a protagonist that goes through the book, stories about this, that, and the other. And the real key for me was about 30 pages where he talks about a specific situation. So I'm going to go into that in a little more detail. So there's a brig. Remember, we're back in sailing times, guys. Okay, so there's a brig, and it wrecks on Midway Island. Midway is, of course, in the Pacific, famous for the carrier battle of World War II that happily my father missed. Our protagonist is a wrecker. And a wrecker in this context is somebody who goes out and salvages wrecks, salvages the cargoes, salvages this, that, and the other. And he has a little partnership, and they hire men, and they go do this. And they find out about this brig that's wrecked, and they go to they go to the auction to see if they can acquire the brig, and then they're going to salvage it. And they know that the cargo was valued, insured value of the cargo was $10,000. A lot of it's rice, so that's not worth too much. It might well be damaged by the water. But the ship is pretty sound, so they don't think it's going to be too badly damaged. But there's also tea, silks, and Chinese notions. I assume that's porcelains, things like that. So they go to the auction, and they're sure that they've got the best business going. They can salvage the ship more efficiently than anybody else. So they know with certainty they should be the winners of this auction. And they start out thinking they're going to get it really cheap, but the bidding quickly gets up to $5,000. Remember, we're in a time of real money, so $5,000 is quite a bit. But there's competition. People are bidding against them, despite the fact that they know they should win it. So they raise their bid, and they think, well, these other people must know something that we don't know, and we better bid more. And they think to themselves, well, there's the cargo there, but there's also the ship's boats. Those would be valuable. We can recover those. And there's the officers' cabins. They might have something of value. And the bidding goes on. It gets up to $10,000. Now I'm thinking, man, we know we should be the winner on this. And then all of a sudden it occurs to them, well, this ship was in China, so there's probably opium hidden in this ship. We've got to take that into account. We're going to find this opium. We're going to smuggle this back into San Francisco. We're going to make a lot of money on this. These other guys obviously know something we don't know. We're gonna buy this. Now, the reason I love this story is it is the perfect example of style creep and decision creep by an investor that I have ever read. You start out thinking you want to buy X, its price goes up, and you find all kinds of reasons why it's more attractive than you thought, even though you say you're a low PE shop or a high private market value shop. You find reasons to creep your style as you become in love with the stock. And this is exactly what happens. Back to our story. So they're bidding more, the price goes higher and higher. They just know that these other people can't do it as well as they can. They've got to get this ship. They end up bidding $50,000. They go out to the ship. They recover the silks. They recover a lot of damaged rice. They recover the boats. But it's not worth 50 grand. In fact, it isn't even worth 15 grand. Now, why were the other bidders bidding? The other bidders had a whole different set of reasons to bid. They were bidding because there were 14 murders committed on the ship, and they were trying to cover them up. All right, that's my story of the Flying Scud. It's 30 pages. It starts at about page 165 in my copy, but you can read about it. All right. Those are my talks. I'm ready to answer questions, and then after we answer questions for a while, I'll talk about my book, but not too much.
Is there an analogy of all the 15 murders with investors?
I like to not think that none of us professional investors have murdered that many people, but it's probably not the case. We probably have.
Oh, that's great. No, thanks, Rich. It's always, like I said, it's an interesting reading list, and of course, as everybody can gather, Rich he was famous within T. Rowe for many reasons. His originality was one of them, and his focus on doing his own work and the seriousness with which he did it. For those of us who considered ourselves more value investors, Rich was a huge inspiration, for many years now. I wouldn't paint him with the brush that he's, that he's been too much of an influence on me because I wouldn't want to, interrupt his sleep patterns, worrying about like the responsibility that comes with that. But I definitely drew a lot of inspiration from Rich's framework and from the framework of a lot of investors who were there. But that's why I've always kind of been a fan of all these many years of Rich, and really enjoyed our conversations. Well, so, and along those lines, Rich, one of the things that we were talking about was this whole war in the Ukraine situation, volatility going up, and this kind of idea of risk mitigation or raising cash levels is one kind of method for that. I know you've got a view on that. I mean, how would you best express that?
Sure. Well, let's talk about, well, first of all, Ukraine has been an eye-opening experience. I hope you can see my Ukrainian colors, but seeing pregnant women covered with blood is really kind of painful. But I think war has always been painful, and this war has been, however, unique for something that's happened. The sanctions, which I am perfectly prepared to think are the right things to do, have really kind of astounded me. I never thought we would do something like that, but I think they're the right things to do, but I never thought we would. And it's certainly better than getting involved in a war. So that's really been a surprise. But there have been two other surprises which I think are just, or at least, two other surprises just as important. One was this closing off of bank accounts. Now, you've heard about what we did to the Russians, but let's say you had given, you'd given money to these characters. I'm sorry about the phone in the background. Let's say you'd given money to these characters that were stopping the traffic through the hold on just a second. Yeah, got it. Let's say you have given money to these characters that were stopping people going through the Detroit Tunnel from Canada, and Mr. Trudeau declared you a terrorist and froze your bank account. Well, I mean, I'm not in favor of stopping people going through the Detroit Tunnel, but wow. I mean, froze your bank account? If you sent $50 to these rascals? That was a pretty eye-opening experience for me. The other thing that happened recently, it was just as brutal, was the London Metal Exchange shut down the nickel trading and canceled a whole bunch of trades. Man, that is a serious. I mean, these Chinese guys lost $1 billion and they didn't have to lose it. I mean, that's crazy. So there have been very serious things that have happened in the context of the war, which I think we should all pay attention to. Now, let me go back to cash. Ideally, you'd sell stocks at the top and you'd buy them at the bottom.
Well, that's what you did, Rich, right?
Oh yeah. Oh, absolutely right. But other than myself, I've actually never seen anybody be able to do it. So what I have seen is I have seen people effectively rebalance portfolios with cash, and I have seen people use cash to dampen their volatility. And I think that makes sense, and that is doable, and it's worthwhile. And since you managed to get me started on this, when I started managing a capital appreciation fund at T. Rowe, I was really long in the tooth at at that point. And I'd witnessed a lot of clients doing very poorly. And I wanted to see if I couldn't figure out a way to fix that. So I did use cash, and I used a diversified mix of assets, and that dampened my volatility. And as you know, I managed to go 10 years without having any down years, which was pretty good accomplishment. But just to give a little more detail, we did a study at T. Rowe, and I was sort of I don't deserve any credit for it, but I lacked as a good portfolio manager. I was quick to plagiarize it. We looked at 10 years of funds ending in 1988, and we saw that the index of those funds that they were competing with had about an 18% compound annual rate of return. It was a very attractive return. And the funds, and now of course they have expenses, et cetera, et cetera, et cetera. And there's the loss from whatever the portfolio managers do. They had 14% return. But the shareholders of the T. Rowe Price that invested in those funds had 4% returns. And it just a brutal difference in return characteristics over an incredibly good period, a 10-year period of time where the stocks have done very well. So I think it's important that you want to have a mix. I think you want to use diversification to dampen volatility. I think you want to recognize problems, but I don't think you use cash much more than that, because I've never seen it really done, even myself. I wandered around, Louis. Is that?
Yeah, no, Rich.
You happy with that answer?
Yeah, I did have kind of a follow-up question for some of those who've joined us, late. I mean, if I were gonna summarize some of the lessons or things I saw, from you and your execution of the Capital Appreciation Fund that were really meaningful. Like you hit on one of them, like I said, 10 years with no down year. And I think was that 92 to 02, and there was a lot of volatility in there. I mean, incredible, really. And that spoke a lot to your risk management and the practice of diversification. As I recall, like I said, there was a mix of, say, bonds, convertible bonds, and equities, and of course, all thoroughly researched and diversified. And that definitely helped to dampen the volatility. The other thing that I thought was remarkable, Rich, was that you did that during the period where I think the NASDAQ fell 82% peak to trough, the internet bubble. And I think you may have been on some of these past market happy hours where we've talked about valuation levels like, Tobin's Q, which is a replacement cost measure that I know you care about, or CAPE ratios that show that the equity market is very at a very high level historic in terms of historically valued. And so and a lot of my ulterior motives in the conversations that we've been having has been kind of, how do thoughtful people navigate through a market like this. And so maybe if you could just talk a little bit, maybe if you think back about navigating that time, was there anything that say, that you would have liked your kind of clients to know as you were trying to, put up the track record that you did was remarkable during that time, just in terms of, is there anything now with the benefit of history that if you could have told people back then and that process was starting, what would you have told them?
I would have told them that the bureaucrats, well, I probably shouldn't say that. So there are a lot of people screaming at you to do X, Y, and Z. And you have to maintain your style, and you have to maintain what you think is the right way to approach it. And just because, the market goes up 16 and you go up 12, doesn't mean you're an idiot. And, you got to just play the game you know how to play, and not get, shunted off. I mean, I had directors telling me I was an idiot for many of those years, and I just refused to change. And that was the hard part. The hard part isn't saying, these stocks are too expensive. I'm not going to buy them. The hard part is saying, I'm not going to buy them despite the fact that everyone's screaming at me to buy them. And clients that get seduced by, you know, current returns will be the ones that sell out, you know, and won't stick with the program. I have a friend that I went to college with, and he's the man for making plastic model cars. I mean, you know, this is not a sophisticated guy, and he asked me what he should invest in, and I gave him a list of stocks or a list of funds, and he bought them all. And then I don't know, 6 months ago, he called me up and he said, you know, what should I do now? And you know, I said I was very cautious, and I asked him, you know, what he'd done with the different funds he owned, and you know, sure enough, he had sold the best fund for the time ahead because he wanted to get more money. He thought he knew absolutely nothing about it, but he thought, you know, this fund hasn't done as well as the others. I'm gonna buy the ones that have done better, and that's not the way to do it. So.
No, for sure. Well, and if you think about, you know, again, like one of the things that I really got a lot out of my time there was when the portfolio managers would kind of talk about, you know, kind of look back at their career and say, you know, this was, you know, the biggest mistake I made, or this is the thing I wish I would have known, you know, beginning, you know. So when you reflect back on all your time in the markets and all those cycles, Rich, I mean, what are the big takeaways, you know, for you in terms
So you want me to tell you what my biggest mistakes were? Is that what you just asked me?
Well, I mean,
you just asked. All right, I'll do it.
Well, I know this is hard for you, Rich, because you've had so few in your career.
Yeah, right. I've had plenty. My biggest mistake was Lehman Brothers, the Lehman Brothers bankruptcy. I thought when Lehman Brothers went bankrupt, when was that? It was
2008.
Yeah,
September 12th, 2008.
Yeah. I thought that was the bottom.
Yeah.
And I put a lot of money in. And I shifted to more aggressive names. And I got that wrong. That was my biggest mistake. Painful.
Rich, a little bit of context, Rich, you know, I think, you know, we've kind of breezed over it to a degree. Lewis touched on a little bit, but, you know, your role at T. Rowe Price and kind of stewarding the capital that was in the fund at that time, through your tenure, what was the most capital that was in the fund at that time? Do you recall?
When I left in 2001, it was $2.5 billion.
So, you know, I think it's helpful.
Started at 100 million and went to 2.
Yeah, that's good context for the viewers, right? Because the decisions you're referring to right in this moment, Lewis and I have spoken at length about this, of, you know, delineating between the data and valuations and what we see on the screens, and then the human capital behind it, right? It's dollars, it's savings, it's college plans, it's retirement plans. You know, what was the greatest way you found to kind of navigate the pressure when you were making that decision without absolute clarity on, is this the bottom? Do I put risk on?
Yeah. Well, my experience had been, that's a good question. My experience had been that every time there was something like a major bankruptcy, like, for example, what was it, long-term? What was the
long-term was 1998. Penn Central was 87, I think it was.
Yeah. I think Penn Central was sooner than that. But also the crash where, you know, all these idiots that were boosting portfolio insurance, you know, all that unraveled. So, you know, these crashes had come, right? And my experience has been that these crashes always brought forth a flood of money from the Fed, and we obviously saw that in 2009, and we saw that in 2020. You know, very consistent. But the '08 Lehman Brothers bankruptcy, which I thought was very significant, did not bring about this flood of money. And I still am kind of shocked that it didn't. And I think had it, we probably would have been better off, because might not have needed to do quite as much in '09 when we finally did do that. Anyway, that's a macro mistake that I made. Unfortunately, you've triggered thoughts of my other mistakes, and they're coming clear to me. Another mistake that I have made, and I have made it more than once, although I try very hard not to, is not really understanding the motivations of the managements of companies. They're very good at pretending they're in it for me and their shareholders, but they aren't necessarily. And I've made that mistake more than once. It's very important to understand how a company makes money and the repeatability of its ability to make money, and then you don't get sidetracked. Now, I never liked fracking. That's a term. It's, fracking shale oil, shale fracking to get petroleum. I never liked it because it had such a short window of time that the wells produce money. So I never managed to have a problem with that. But that is a perfect example of fellows that appear to be doing something very effective economically, and they really aren't. And they're really sort of in a management compensation scheme. And I have made that mistake. So that's a mistake.
Well, maybe I remember kind of prompted your thinking. I remember we had one of those sessions with Jack Laporte, sadly, a wonderful gentleman, sadly passed away from cancer not too long ago. And I remember it was interesting. Jack's biggest mistake was selling Starbucks because coffee prices were going up like in 1992. And that's the way he phrased it. It was something that he should have owned, but kind of didn't, so it wasn't necessarily that he bought XYZ and went down or whatever, but, it was just interesting to hear how people would frame these things. I mean, one thing I guess I would say about your comment about Lehman, we've tried to think about that in terms of watching the credit markets. The way we've described it, I'd love to see if you got a different view. Is it basically the credit tranche of the capital structure is a senior tranche, and so as long as that's doing poorly, equity's probably doing poorly just by definition. And so we tend to look at credit stress measures when we're trying to put money to work at turns and this kind of stuff. My recollection of that was that credit spreads, this BAA to AAA spreads, kept blowing out to the 18th of they peaked on the 18th of December, I think, 2008. And that was a turn, but there was plenty of volatility then, kind of just like there is now. I mean, and maybe with your, again, Rich, thinking about your experience kind of navigating, what were kind of historic volatile markets. I mean, was there anything that you look back on, then in terms of, part of your process or in terms of, because you just had amazing performance during that time period. I mean, to what would you kind of attribute that, or if you've got other investors that are trying to, mirror that, time of glory or whatever, what would you do?
Well, I had about a 17-year run of incredible performance. That's true. But then I had about a 7-year run of, after that, sort of not so incredible performance. So. It happens. I think one of the reasons I was successful was that convertible bonds were inefficiently priced going into the the start of that 17-year period. And we hadn't really developed an understanding of how to use computers and how to manipulate the terms and understand the terms. And I was willing to sort of do these things by hand, and it was a significant incremental value. And another thing that was unique for me was I was willing to buy gold stocks. I never had more than, about 5% in gold stocks, but when they were cheap, I bought them. When I thought the price of gold was attractive, I bought them. That was a big help, Lewis. But just dampening and rebalancing, those things sound so pedestrian, but they were very effective and important.
You mentioned price of gold, and when you found it attractive, you'd buy the gold stocks. So what did you look at when you were thinking about the price of gold and when it was attractive?
Yeah, good question. Really, you should think about gold as, you shouldn't really think about the price of gold. What you should think about is the value of paper money. Not the gold that stays the same. What goes up and down is the value of the paper money. No, excuse me. What goes down is the value of the paper money. That's the whole issue. When there's a lot of paper money put out there, the perceived price of gold is going to go up, and we're in that kind of a period right now. You can't believe how dumb these people are, right? I'm telling you, they are dumb. Listen to them. They're saying, we can have anything we want. Our president just introduced, Build Back Better. He's crazy. I'm not in any way against the things he wants to do, but you gotta pay for things. There's a quote in Andrew Dixon White's book, which I love. He says, we can use the printing press to pay for all our bills. We don't have to pay taxes. We don't have to do it. This sounds like Bernie Sanders. This sounds like AOC. That's exactly what they're talking about.
Well, there's nothing new under the sun. Huh?
No, there's nothing.
So another great value
The point
investor.
you're making, Rich, right, is that you're not opining on the ideological or the ethical points
No.
that are being debated, right? It's the reality and the feasibility of how do we implement and finance these objectives, correct?
Right. No. I want everybody to go to college. I paid for like 15 kids to go to college. I have. I don't mind paying my 35% tax rate. I don't mind the fact that Donald Trump raised my taxes enormously. Everybody says he lowered taxes on the rich. He sure didn't lower my taxes. He raised them. I'm not bitter, but well, of course I am bitter, but
Well, Rich, let me ask you kind of a gold-related questions. Those who've been, following our research of these pieces know that, we lean on gold or gold-related investments as a diversification, particularly in stressful times. Frankly, we probably never had more, precious metals related things in the portfolio. One of the things motivating, this is what I want your view on, is that I was just thinking back about the example of 29, when of course the market got wiped out tremendously, and how well gold held up there on a relative basis, which means if equities fell 90%, means your purchasing power in gold went up tenfold relative to equities. If you think about the wipeout that began with the tech bubble, gold, I guess, would eventually go up like sixfold over that cycle. Equities would go down. So again, your kind of purchasing power of things you could do with gold was. So gold was exceptionally valuable in retrospect at those periods when equities were historically highly valued. So I ascribe some, that this it makes this an especially useful time to own that. I don't know if you've got a view on that or if you would disagree, if you think about that differently, Rich.
Uh, yeah, I'm not prepared. You know, I think the 1929 experience was a particularly unusual one. High quality bonds did very, very well. Everything else just did awful. Gold, of course, in nominal terms went up 65%, and in purchasing power, as you said, purchasing power went up tremendously. Home stake mining went from 4 to 40. That was pretty good considering the market was going down 85%. You know, it was a good time to own home stake mining. I'm wandering around. Have I lost the thread of your question, Melissa?
Well, no, I guess, I mean, this was a discussion that literally Zeb and I were having today, and it was kind of, there's kind of two, I would submit there's two things you're trying to think about. One is what's going to happen kind of in the future. The other thing is kind of how the financial system will translate that into reality. So if you think about the cycle of the 20s, is, you know, home stake mining did great because their revenues were flat and their costs fell because of deflation, because of the nature of the monetary system. That's why home stake was such a huge stock. It had 80% of the total return of home stake took place before FDR revalued the dollar in 34. And so, of course, there were people that had that proxy that not thought it through well going into 08. Gold stocks crashed 85%, you know, and so they kind of were close, but they weren't all the way right. And so a lot of times we talk about that as research teams saying, like, let's be sure let's try to get all the way right. You know, you can be kind of right and be dangerous, but that's kind of, you know, how we're trying to think about that. You know, so how is the current system set up and how would it take these shocks?
Yeah, and the nice thing about gold is we don't know how it's going to take these shocks. We don't know exactly what's going to happen. So we're a little bit flying blind, but that, you know, that doesn't mean we should try.
Yeah. Well, I remember another saying from T-Rex I thought was great. Maybe I heard Dave say it, he probably got it from you, honestly. It was almost like the cheaper the stock was, like the less you had to kind of forecast its future. You know?
Yes, yeah, absolutely. Do you have margin of safety? The Baupost phrase, you know, and I think with gold, you don't know exactly how the new thing is going to shake out, but it's going to be something, and you're likely to win. That's all we can do as professionals. You know, sure, occasionally we know for sure that a stock is really attractive, but lots of times, you know, we don't know exactly how, you know, it's like the wrecker. I mean, he knew he could make money at 5,000, but he decides he has to bid 50 because the other people know. Well, you know, the other people did know, but it was a whole different thing.
So you started out this conversation talking about the Fed and you know, the auto mechanic and how they're clueless.
Yeah, right. Absolutely clueless. And they were obnoxious to this man, just obnoxious.
Yeah, I actually have a funny story on that. I'll tell you offline. It's a similar story, somebody who met with the Fed. But anyways, any like thoughts on this tightening cycle they're entering in, given that they're clueless, and how it might all play out?
So, what is this guy's name? What do we call him? Transitional Powell? Is that his name? Mr. Transitional Inflation? Yeah, come on, guys. You really? And we're paying this guy what, $175,000 a year? He's never made any money for anybody. You know, talk about right out of the Andrew Dixon White Book. I mean, he's just as bad as well, all right. I'm getting into a rant, but no, you can't tell what they're gonna do. Now, if he starts tightening, like, you know, he says he's going to tighten because he's going to control inflation. Well, maybe he will. But how do we know? How
So
can we
what
possibly
does this
know?
mean, Rich, for like you talked about diversification in a portfolio, and it's one of the things
Yeah.
we can do to kind of inoculate against these, crazy hurtful outcomes. I mean, it's perhaps that's a useful example. I can tell you we have an investment piece that I've used in prior seminars, and the title has never changed, and it's called Investing in Uncertain Times.
Hmm.
And I've gone 10 years with the same topic. Spoiler alert. There you go, everybody. Now you know.
Yeah.
It's
Well,
all-
I went 10 years with the 7 Pillars of Wisdom. So, you can, if it works, keep using it. I firmly believe that. If you've got a system that works, keep doing it. If what you're doing is plagiarizing somebody else, keep doing it. If it's working.
Well, Rich, I mean, why don't you take a couple of moments? You talk about, you haven't mentioned the book that.
Oh yeah, right.
Yeah, and well, I mean, so I was going to ask you a quick question about it. So of course, I think I shared with you, I didn't realize that we had that shared experience of losing I lost half my family by the time I was 18. You managed to one up me and lose.
Yeah, I managed to lose everybody.
Yeah, you lost everybody.
Yeah. First when I was 8, and then when I was 18. But,
yeah. I mean, and I guess as an outsider looking in after reading that book, there was a lot I felt that explained to me about the way you thought about investing. That you clearly cared about people and knew that bad things did happen to good people.
Yeah.
And I felt like that was I could understand your motivation in through reading that.
Yeah. Bad things do happen. There's no question about it. So when I wrote the book, it was more of a sort of a stream of consciousness for my childhood, and I had never really sat down and done that. But it was a very unusual childhood, and as you mentioned, Lewis, I did lose my family when I was 18. My family was killed in a very obscure and unusual plane crash in Cairo, and but there had been many other things that happened in my life that really were the perfect preparation to being a professional investor, which I don't know anybody else that's ever had. I mean, that's pretty strange. But when I went back and looked at the book, I began to see all these influences that had happened in my life. At one point, I'm talking about an irrigation system that was built back in the like 800s by the Arab civilization, and they had developed ways to keep the canals level, the underground tunnels level, and the old ways work. They do, and the old ways of investing work. You're continually being told that this new system, this new technology is going to change everything, and sometimes it does. But that doesn't mean you should throw away the old way of thinking about problems, and I always remember that. I always remember also growing up, my first, strange as it may seem, the first book I ever read was called Their Finest Hour by Winston Churchill. It's about 500 pages long. I never read the Dick and Jane readers because I couldn't read at that point in my life. And then 40 years later, I found out that this just absolutely fraudulent information that Winston Churchill put out there. And I'm reminded that everybody knows stuff that you don't know. So you're always making decisions in uncertainty, and you better pay attention. That's in the book.
Well, and along those lines, Rich, like I said, if you're, a lot of the people who are on this, call, some of them are investors with us, some of them, invest privately, just want to do a better job. I mean, is there any, you know, I mean, I don't know how to ask somebody to sum up 50 years of it, a very prolific investing career. But, you know, if you were going to try to, you know, tell people the two or three things to minimize the chance of failure, maximize the chance of success, you know, based on drawing from all these points, I mean, what do you say?
I think the people that you're with are enormously important. All the people in your lives make an enormous difference. You need to try to understand them. You need to try to understand how they influence you and how they make decisions, et cetera, et cetera. That's important. Very significant. I think you can't be taken in by the situations that aren't appropriate, you know, that don't have meaning. You know, don't be upset because your neighbor has more money than you have. Don't be upset because somebody bought Amazon in 1999 at, you know, 3 cents or whatever the adjusted price is, and you didn't get it, and maybe you should have. But you can't. Those things aren't important.
Well, I was curious, Rich, kind of why you, of all the things you could have chosen to write about, you know, you chose that one period in, you know, in life, and I think your story kind of ended very, you know, clearly around your family. But I thought it was just kind of interesting, you know, why people choose, because there's so many things you could have written about you didn't.
Yes. Yeah, I wrote about also. So I wrote that story because I was convinced that there were things in my life that were relevant to a lot of people that would be lost if I didn't write the story. How's that sound?
No, it makes perfect sense.
So my father built the first girls' school in Arabia. And Aramco did not want it built. He built it for the Arabian American Oil Company, and Aramco did not want it built because it was such a change. And I wanted that. I wanted it in the record that he built it, despite the fact that they didn't want it. I wanted in the record that the accident investigation of the plane crash that killed my family was absolute bogus nonsense. I'm a little bit irritated on that subject, as you can imagine. But that's so. I wanted it written down. Nobody has written it up. You know, it's clear that the airport at Cairo was a bunch of idiots, and they did not do their jobs, and they whitewashed it. And yeah, so I wanted that. So there were things like that. But then also, Lewis, I just felt I had a good story, and I think you know, look at, I could write about value investing, and would it be all that unique? I mean, other people have written pretty good books about it, and they're great. I read them, I like them, but I don't think that's I don't think you engage a lot of new people with that story. And I want to engage people. I want to tell a story that I like. How's that, Lewis?
No, it's perfect, Rich. I have one more question for you, and then I want to see if there's anything that we've left off that you want to leave our listeners with and everything, because we're kind of bumping close up on our kind of allotted hour. I mean, and just curious, Rich. I mean, that's just opinion, but in terms of, there's a lot of people debating about whether or not we're kind of seeing the turn here in kind of more of a broader kind of commodity cycle or natural resource cycle. I mean, that's an area you spent 50 years looking at. Do you have an opinion on that? That's one question. The second one.
Yeah, that's a good question.
And the second one, Rich, I would just ask, like, in summary, is there anything else that you want to chat about or just leave with the viewers before you let them go?
Okay, so let's talk about the commodity cycle. I think we have several things. One, we may be at a significant turn in the commodities. We had, you know, when I went into the business when I became a professional in 1971, as opposed to an amateur in 1966, I guess, when I bought my first stock. There was a very different feel about commodities and the opportunity to make money and the stocks that you could buy. And it sort of feels like we're back to that same situation. That's number one. Number two, I'm all in favor of having the best possible environment you could possibly have. I'm not smart enough to understand global warming. I'm neither for it or against it. I know that everybody hates me. The people that are deniers hate me because I don't deny, and the people that are in favor of it hate me because I'm not smart enough to accept it. But I'll tell you one thing it's done is it's forced a lot of very simple-minded people out of owning energy stocks. And because they've been forced out of them, and then because those stocks have gone down so much relative to the market, the stock market in general, I would not be surprised if we have a significant period of time where energy is a very attractive investment. It was, at one point in my career, it was 32% of the S&P. It was barely over 2% 18 months ago. I think it's a little bit under 4 now, but we could certainly see it double. There just hasn't been enough dollars going into the ground because everybody's afraid that they're going to make investments and then they're going to lose out to these new technologies. And there is some risk to that. I'm not. So anyway, you ask about that. I think that's really important. The ESG focus, I'm strongly in favor of governance, right? That's the G. I'm strongly in favor of in the environment, but I'm not confident that the environment is really better, that we have all these windmills killing birds all over the country. I'm not confident that solar is a really effective technology. You asked me earlier, Lewis, about my biggest mistakes, and another one has popped into my mind now that I'm talking about the environment. I thought that the United States would surely maintain the company that was responsible for making the fuel for nuclear power plants.
I remember talking to this about you
Yeah.
with you a while ago. Did they let that go bankrupt?
Yes, they did. And I was a bondholder. And while I personally recovered all my money, my clients, who were not quite as willing to hold on as I was, lost quite a bit. And I feel bad about that. I'm not sending them a check, but I do feel bad about it. I did think that was something that would be effective, and that it would be a very positive environmental thing to have nuclear power. And obviously, perhaps I was 5 years ahead of my time. I think that's starting to get recognized now that we should have nuclear
Yeah, but isn't that getting a little more complicated now, though, given that all the uranium that comes out of Russia and former Soviet, in Kazakhstan in particular?
Well, like most people, you think that uranium is fuel. It is not fuel. Fuel is U-235, not U-238. Most uranium is U-238. 0.4% of that is U-235, and the fuel is getting that percentage from 0.47 up to 4.5 or higher. And that is almost exclusively done where? In Russia. And I just can't believe we allowed our domestic industry to go bankrupt and close all the plants. And I really, that was a mistake of mine, and was because I was too environmentally friendly.
But you were early. You were a man before your time, even then.
I was a man before my time, and it was painful.
Yeah.
So it was a mistake, and yeah,
No.
I'd like to forget that one, actually.
But no, look, I wanted to say thanks, Rich, for your generous gift of your time to help. I can't tell you how much I've gotten out of the time you've allowed me to, pick your brain and bounce ideas off of you. Aside from being, an amazing value investor, Rich is also a wonderful gentleman, as everybody can tell. But I deeply appreciate you making time available to share your views and let kind of our clients and friends kind of piggyback along. Hopefully they've gotten as much out of as I am.
Yeah, let me end by saying I think the people you go through your life with are very important, and people that are trying to do the right thing for clients always have resonated with me. I worked at 4 different organizations. I had many good friends from all of those experiences, but I have seen some organizations be much more committed to their clients than others. And I know, Louis, that you are. That's always impressed me. So on that note,
That's a great note. That's a great note to end on.
No, for sure. And I didn't even pay Rich for
no,
that.
you didn't pay me for saying it, but it's true. I really mean it.
No, that's very kind. Daniel, is there any thing you need to leave everybody with in terms of the survey and other things, perhaps?
Yeah, Rich, thank you so much for taking the time with us today. And we had a lot of really thoughtful questions come in. Unfortunately, we weren't able to get to all of them. Rich has probably forgotten more about investing than most of us will ever learn or know. So as much as we'd love to sit here for another couple hours and pick his brain, we're out of time for today. But, we would encourage you, please reach out, whether you're a client or just a viewer tuning in today. These are uncertain times. And, I think Rich has done a nice job of shedding light on kind of the human component and the emotional factors that come into play when investing is, front and center. So we would encourage you, reach out, have the conversations with us. We're here to be a resource in any way we can. So thank you all for tuning in. We would appreciate if you'd fill out that exit survey on the way out. And we look forward to seeing everyone on our next Market Happy Hour.
Thanks for having me, guys.
Thanks, everybody.